Alright, this is the Forex blog post for January 11th, 2011. We're going to go through the currencies. In this case, you have the weekly and monthly trend that's down. Price is above the hourly moving average. When it finally breaks down, you might have went short here. Your profit targets here and here. You use support resistance areas as likely areas the market could stall. Now, if the market comes down and you see incredible weakness here, it's very likely to go through it. If it comes down with almost no momentum at all, it's likely to stall here. So, if you are only up 20-25 pips in a trade, get out. You might have shorted again here when it came back up and tested the hourly, didn't go above it, and the market pulls back 10 pips. That's more than enough to move your stop to break even, and it didn't go back above this high, so sometimes you have to get back in, and the market went down again, double bottomed here with almost no weakness. That's a pretty big sign the market doesn't want to go down, so you might want to wait and see what happens on the upside. You can see it came up here. Because the longer term trend's down, on a scalping basis, when you see a double top with less strength than before, and it never had a whole lot of strength before, you might have sold this after giving it a little bit of time, or when it broke underneath this low here, or the hourly. Let's look at the currency meter. That's one of the easiest ways of finding strong and weak currencies. You have a very strong dollar today, and you want to trade that against one of the weakest ones. Last night before midnight, it appears that the Australian was one of the weakest pairs. So you want to sell the weak Australian versus a strong dollar. It's that simple. And look at this, right before midnight, this currency also already had a weekly monthly trend that was down. It went up to the high here and then went sideways. Aggressive traders, when the market goes up and then the momentum slows down and it goes sideways, this is one of our entry methods, multi-hour sideways rectangle patterns. And you can see it pull back about 25 pips, rally back up again without that much strength, and you can see the strength is less than the weakness. Aggressive traders could also look to go short here. This is kind of a 1-2-3 pattern. And another safe entry is once hourly gets hit and doesn't cause much move up, when it gets broken the second time, it's likely to go here, or the next area of support's all the way down here. So you can see this is a home run. You took this trade expecting possibly a 10 pip loss if it didn't work, and here is your likely profit target down there at 10. You were estimating 15 pips while risking 10, and instead of only making 15 pips, it went down to this area where it's a decent place to get out of half, and then the market goes down underneath this lower containment band. This is also our trend explosion system. Anytime you see a plus or minus 20, anything that hits the white line, especially when the weekly and monthly trend's down, you want to sell the next move up. So you might have gone short here, probably got stopped out at break even, or maybe you lost 5 pips. You went short again, and you can see the market fell another 30 pips. Fib levels underneath lower containment bands are great places to not only get out of your trade, but really consider getting into the trade once you see at least a double bottom. So you might have bought here because it wasn't that weak, and rode it up about 10-15 pips. Came down again, did not break lower. You can see the weakness is getting less, is getting less, is getting less. And usually if markets aren't going to go down, they're going to shoot back up. The next resistance area is all the way up here. And this time the estimated profit target was pretty much all that there was. If you had bought down here around 30, it went up 50 pips. Now anytime you see a currency this week after a decent pullback, this is also our Elliott two-wave fib pullback system in its perfection. The first wave up, you draw your fibs. Usually when there's a strong trend down, the market will stall at the first or second fib target. It also helps when you have a monthly pivot level right here, previous day's lows right there. There are multiple different areas and reasons why there was massive selling, and the move up didn't have that much intensity. Here I might not sell something that's going up at or near the 20 level, but this wasn't that strong. So you can see a nice little 25 pip move down, came back up again, still wasn't that strong, didn't break over that area, you went short again, you made another 30 pips. So when you find currencies that are on our currency meter, one is super weak, the other one's super strong, not only does it give you opportunities, but after the counter trend wave is over, like you saw today in the Australian dollar, it gives you other opportunities. Let's look for some other currencies that had some weakness. Now, the New Zealand wasn't nearly as good as the Australian. Notice the weekly and monthly trend is up on the New Zealand rather versus down on the Australian. If you have your choice, trade the currency that has a much weaker longer term trend. The weekly monthly trend's down in this, whereas it's up in this. Doesn't mean you can't make 15 to 25, 30 pip moves off of short-term momentum, but it's not as likely to continue down, and you might not look for an Elliott 2 wave type pullback in the New Zealand dollar versus the Australian dollar. Let's look at that currency. You can see last night showed some weakness. Now, if you got short right here, you lost because, again, the longer term trend was up. When it finally broke that low last night, you can see you had, small opportunities. You might have made 5 or 10 pips here. Went to our fib level here, and because the longer term trend was up, obviously the weekly trend had shifted down last night around 10. But fib levels right at or below the lower containment bands, which are likely reversal areas. Notice how it reversed almost to the pip at our upper band. These are statistically based on the last 20 days maximum volatility. So unless today's volatility is more than the past, usually you're going to get some stoppage there and reversals. So, this one wasn't nearly as good of a trader because, for one, there was a fib level here, whereas in the Australian there wasn't. And the weekly and monthly trend of this one wasn't weak like the other one. Now we also had some weakness here in the yen at 6. Now the monthly trend's up slightly, the weekly trend was down, slightly shifted up. So you're not fighting super strong longer term trends in this. And at that time, the pound was one of the strongest ones, and the weekly trend was up. So the pound yen was a great currency to look for buys after about 6. And notice here's 6 o'clock, and the market's stuck in this choppy zone. You have the hourly moving average, which acts as support usually. You have the weekly high above it. And one of our systems that I go over in class, and we don't have it on our video yet, is called the triple top breakout. Anytime a resistance area gets hit once, gets hit twice, this is our double top counter trend system. Usually the first and second time a resistance area gets hit, you can expect reversals. But the third time, usually there's no more selling there. Because people who sold here, guess what? It didn't fall that much. People that sold here are also disappointed. And when it comes up there again, you got all these positions short. If the market does break out and people get nervous when the market doesn't go down, it's probably going to go up. And when it doesn't go up, it's probably going to go down. Markets don't go. Also, this was chopping around at about a 35 pip range all day. So when this broke out, it was a super high probability trade because the daily trend was up, the weekly trend's up, the monthly trend's up, and it broke above this fib level here and acted as support once it broke above it. And this is a great trade. The next fib level is all the way up here, and you can see there's a lot of intensity here. Because the longer term trend's up, you might want to buy this little pullback too. But great trade, and you generated about 25, 50, 75 pips in that trade. And the currency meter found it pretty early. Way before the breakout. You can see right here at 6, this was really strong. It started to show some weakness. It's the first time it hit the 20 level in a couple hours, 1 o'clock and then again at 6. And that's it. You watch these, you put these currency charts up, and sometimes you gotta, wait. You might have got in this trade here at 9 when it broke out. Your stop maybe is underneath this low here. And it went sideways for another hour once you got into the trade before it finally took off. That's just the way sometimes these trades work. Put your stop in, put your profit target, maybe a reasonable one might have been right here, or at least put an alert on your chart, and then come back and take the trade later. Another one that was strong at that time, and we know that the weekly trend slightly up, the monthly trend's really strong, was the New Zealand. The New Zealand yen was also a good one to look for buys after 9 o'clock. So here's 9 o'clock. You can see again this area got hit once, got hit twice. There's no pullbacks, and it's kind of hovering between this fib level down here. Nobody wants to sell right in front of major support, monthly pivot, 200-day moving average, and a fib level, and yesterday's low. There's no reason to sell right in front of all that likely buying area. But once the market breaks out above here, again, the first time it touches, second time it touches, no pullbacks, third time it just broke out. And here's your next profit target level up here. You're going to risk 5 or 10 pips to make a likely 20. And I might have got out of the whole trade, or at least most of it right here, because there wasn't a whole lot of momentum. Pulled back a little bit, and then on the next wave up, usually the fib target of the first wave is where you want to exit your trade. So you might have exited somewhere around 63.45 right here at the first fib target. but still a good trade. You risked 5 or 10 pips. You might have made 20 on the first half and 30 on the second half, averaging 25 pips. And that's 2.5 times what your initial risk is. And you're trading in the direction of the weekly monthly trend. All right, last blog post. You can see extreme strength here in the CAD earlier. Then it had just mild weakness for a couple hours as it pulled back. And then again, 9:30, some strength. You trade the strong CAD against the weaker yen. And it's very similar to the others. You have a resistance area here the first time it gets hit, the second, the third, and you can see it's very narrow range. And this one on top of that had a narrow range 7 inside bar breakout right here, and you go long right here around 83.85. The daily, weekly, monthly trends up, and it takes off right to our previous month's high, 200-day moving average, and our trading zone, which is one of the potential likely highs of the day. So you're even before you take this trade, you're expecting 84.10 as your profit target. That's 30 pips away. You're going to risk 10 or 12 pips for a pretty good chance of making 30 pips. And your odds always go up when the daily, weekly, monthly trend is in the same direction of the trade. And there's no other resistance until right here. So it's pretty much, getting onto the highway at 4 in the morning. There's no other cars, and it's you can just speed up. The market has nowhere to go but up. All the time frame trends, real-time trend, daily trend, weekly trend, monthly trend are all up. And those are some of the best trades. You don't get those every day, but when you spot them, you might want to trade 50% bigger position than you normally do. So let's say you normally do one lot instead of making 35 pips here and 350 bucks. You do 1.5 lots, and you made close to 500 pips or 500 bucks.